Now, as we said, hedge funds employ different strategies to make money, and the risk of investing in a hedge fund is very much more related to the risk of that portfolio manager, that hedge fund manager, making mistakes than it is in the case of the mutual fund, which is more linked to a benchmark and to an index. So in the case of a hedge fund, it's much more a bet on the manager than it is on anything else. But hedge funds do typically operate within certain environments, and there are different types of hedge funds. I'm going to briefly touch on three. The first are opportunistic hedge funds, including long-short equity. And what these hedge funds will typically do is they will buy the stocks. For example, if it's a long-short equity fund, they will buy the stocks of companies that they'll think will rise in value, and they'll short sell the stocks of companies where they think the stock price will decline in value. Hence the term long-short, long meaning owning and short being short selling. And short selling obviously is the process of borrowing stocks, selling them at a certain price, and then buying them back with the hope that they decline in price, and then buying them back at a lower price and making the difference. So these are opportunistic funds, and including long-short equity funds. The second ones are event-driven funds that typically try to benefit from differences in valuations of different securities around an event. So for example, a spin-off or a restructuring or a takeover, they try to benefit from differences in price surrounding securities that are associated with that event. Or they buy in securities that are related to something major happening or a major change in a company. This would involve things like distressed securities, where companies are in trouble and therefore the debt is trading at low prices versus where it was trading before, and the yields on the debt would be very high risk debt. The last type of hedge fund strategy I'd like to touch on is relative value. And relative value hedge funds try to benefit from differences in valuations between securities that represent the same underlying economic interest. So for example, a convertible bond is a combination of equity and debt, arguably, and therefore one could, for example, if one could replicate a convertible bond with equity and debt instruments, one could sell the convertible, buy the convertible bond and sell equity and debt against it short to try and benefit from any relative valuation differences of two structures that would move in the same way under most circumstances, so that the bet that you're taking is really only the bet on the valuation difference. There are many different strategies that hedge funds employ to try and make money, and these are just a couple, but the bottom line is that hedge funds typically are defined by the fact that they are much more free in terms of how they invest. They're not tied to a benchmark. They tend to employ leverage much more significantly than mutual funds do. They also employ short selling, which seeks to benefit from declines in prices, and they're typically also considered more risky and for sophisticated or institutional investors, and that they're not tied to a benchmark in the same way, and that the bet is much more on the portfolio, the hedge fund manager in this case.